I'll welcome everyone to the webinar. There are a few housekeeping items I want to briefly go over. If you're having any technical difficulties, please contact WebEx at 1-866-229-3239, event number 622-670-522. The event password is TRF 2016. This webinar will be recorded and made available after the event. Please use the chat function for any technical questions. You do get credit for attending this webinar. If you want CPE, you should complete and submit a short evaluation survey that will pop up on your screen after the webinar ends. During the webinar, we will share 3 words. The survey will ask you for those words, and you cannot claim CPE unless we receive a completed evaluation with the correct words. Any technical questions about the survey can be addressed to Alina Stone at astone@grfcpa.com or at 301-664-9357. Please turn off your pop-up blockers. This presentation is available to download at www.grfcpa.com/media/228.pptx. Briefly, what our webinar objectives are is to provide you with a better understanding of how to comply with complex areas of Form 990 reporting. You see there that there's 1 hour of CPE. There's a little bit, stuff there that we don't really need to read or go over other than that. And so I want to introduce the people presenting the webinar this morning. My name is George Estrada. I'm a manager at the Nonprofit Tax Department of Gelman, Rosenberg Freedman. I'm joined by my colleagues Jana Godarzi and Caitlin Miller. We're part of our department, which is about 10, 11 people working on taxation for not-for-profits. You see there our agenda. There are 10 areas that we're going to cover briefly, but hopefully usefully for all of you regarding 990s and certain compliance pitfalls related to those areas. And with that, we come up to our first polling question. We will have 3 polling questions throughout the presentation, and we ask you that you answer it. It's helpful to us and I think also to you. Polling question number 1, when do you start thinking about and compiling information for your Form 990? A, throughout the year, B, during the year-end financial statement preparation, or C, 2 weeks before the filing deadline? And we'll give you a few seconds to, give us your answer, and then we'll jump into the presentation. Okay, so I'm going to do this first slide about program service accomplishments. That is that's on the second page of the Form 990, Part 3, and it's the section where you update and review your program accomplishments. A few things we want to say about that. One, it's important to review the text that you provide annually. The Form 990 is a public document. This is a good forum to highlight and boast about your organization's accomplishments. You can be as brief or as verbose, if you will, as you like. There's no rule about that. But, and again, since I'm assuming most of the people joining us here for the webinar are accountants, writing and descriptions of program service accomplishments normally aren't our strength. So it's important that you go out and reach out to your program people or to your communications people to get help on updating this annually. There is a question on the form that asks, did you begin any new significant programs this year? Again, if you have, this is a good way of highlighting any new initiative that you may have had during the year. You answer the question yes, and then in the back on Schedule O, there'll be a description or at least an identification of what this new program is. And the third thing to emphasize is that normally your financial statements also break out certain programs, and it's important that the breakout that you have here be consistent with the financial statements. They do ask only for descriptions for the top 3 programs. If you have more programs, you can also provide descriptions for those in the back on Schedule O. And I think with that, I think we're going to pass to the next slide, which Caitlin will talk about.
Thanks, George. Good morning, everyone. This is Caitlin. Before I get started on my slide, I'm going to give you the first code word for CPE, and that's going to be orange. Again, that code word is orange. I'm going to talk about a few areas of Part 6 of the Form 990, which is governance, management, and disclosure. One of the first questions on the page asks, enter the number of voting members of the governing body at the end of the tax year. This count should tie directly to Part 7, where you list each voting member by name. So if some people came on the board or left the board during the reporting year, you should indicate those start and end dates on Part 7 so that the end of year count can reconcile back to Part 6. The next question on Part 6 asks, enter the number of voting members included in line 1A above who are independent. We get a lot of questions about what board members are independent, so I wanted to review the definition of independence today. Board members are independent if all 4 of the following applied at all times during the tax year. The member was not compensated as an officer or other employee or staff of the organization or of a related organization. The member did not receive total compensation exceeding $10,000 during the tax year from the organization or a related organization as an independent contractor other than reasonable compensation for services provided in that capacity as a member of the board. Third, neither the member nor any family member of the member was involved in a transaction with the organization required to be reported on Schedule L. And then lastly, neither the member nor any family member of the member was involved in a transaction required to be reported on Schedule L of a related organization. And we'll go into Schedule L in a little bit more detail in this presentation, but those are the 4 criteria that the board member would have to meet in order to be considered independent for that question. Another line that we often see confusion on is Part 6, line 6. This question asks, did the organization have members or stockholders? Sometimes we see people answer this question yes, thinking, yes, we have members, our board, or yes, we have dues-paying members. But a member for purposes of this question is defined as someone outside of the governing body who has the right to elect or appoint members of the governing body or approve decisions of the board. So organizations who answer line 6 yes should review the definition of member for purposes of this question and make sure that their members meet that definition. Moving down the page, the next section is Section B, Policies. I'm not going to go through each one of these questions independently, but just generally, the policies mentioned in this section are not required but considered good governance to implement. One question that I will highlight is line 11. Has the organization provided a complete copy of this Form 990 to all members of its governing body before filing the form? Again, this question isn't required to do, but in order to check this box yes, a full copy of the return, so including Schedule B, should be shared with your board. And the board doesn't have to approve it, just as long as you're providing them with a copy before filing, then you can answer this question yes. The only other thing that I'll mention about Section B for policies is that charity rating agencies are often reviewing the responses to these questions when calculating your charity's rating to see if the organization has strong governance in place. So it's important to review these questions and make sure that they're up to date. The last section on this page is Section C, and the line I'm going to focus on here is line 17, which asks, list the state with which a copy of this Form 990 is required to be filed. Sometimes we see organizations list all 50 states here if they're registered in all states, but not all state registrations actually require a copy of the 990 with its annual filings. The required states are going to depend on the organization, but generally for a 501c3 that's registered in all states, this slide is going to show the states that actually require a copy of the 990 to be attached to the filing. So these states will be different if you're completing Schedule G Part 1, which is where you'll list all of the states that you're registered in. But this question here on Part 6 is asking only which states require a copy. So that's important to remember when you're completing that section. So those are a few areas where we see questions a lot on Part 6. I'm going to turn it over now to Jana, who's going to talk about Part 7.
Thanks, Caitlin, and good morning, everyone. I'm going to discuss, as Caitlin mentioned, Part 7 and the most common questions we see while gathering information to complete Part 7. The first area that raises a lot of questions is who must be listed on Part 7. So typically we start off listing all the board members who served at any time during the year. But there is sometimes confusion about who are considered the organization's officers, key employees, and highly compensated employees. So I'm going to start off by walking through who are considered officers. The IRS defines officers in two manners. First are the officers that are determined by reference to its organizing documents, the bylaws or resolutions of its governing body. So that's typically the officers of the organization's governing body, for example, the board chair, treasurer, or secretary. The second definition of an officer for 990 reporting purposes are the organization's top financial official and top management official. So the top financial official is defined as the person who has ultimate responsibility for managing the organization's finances. For example, the treasurer or chief financial officer of the organization. The top management official is defined as the person who has ultimate responsibility for implementing the decisions of the organization's governing body or for supervising the management, administration, or operation of the organization. So for example, that's the organization's CEO or executive director. And then next we have the designation of a key employee. So to be a key employee for 990 reporting purposes, the individual must meet a two-pronged test, a compensation test and a responsibility test. For compensation, the individual must have over $150,000 of reportable compensation. And we'll discuss in detail what the IRS defines as reportable compensation shortly. The responsibility test requires that the individual have responsibilities of those similar to an officer, director, or trustee of the organization, and have management over a discrete segment of the organization. And finally, we get to the highly compensated employees, or HCEs. The IRS defines an HCE as the top 5 employees who received $100,000 or greater of reportable compensation and was not previously listed as an officer, director, or trustee, or key employee. Other things to keep in mind is that these definitions are mutually exclusive. So if someone is listed as an officer, they should not also be listed as a key employee or HCE. I mentioned reportable compensation a lot, so what does the IRS mean by that? Well, for 990 reporting purposes, reportable compensation generally refers to compensation reported on the individual's Form W-2, Box 1 or 5, whichever amount is greater, and if an independent contractor, the organization should look to the individual's Form 1099 and report the amount listed in Box 7. A question we commonly receive is which year of the W-2 should we be using to report this compensation? To determine which W-2 or 1099 we should be using, or which persons are listed on Part 7, Section A, the organization must use the calendar year ending with or within the organization's fiscal year. So for calendar year-end clients, that is pretty simple. If the organization's fiscal year ends December 31st, 2015, we should be using the 2015 W-2s or 1099s. However, it gets a little trickier for fiscal year ends. If the organization's fiscal year end is June 30th, 2016, the organization should be reporting the information from the 2015 W-2s or 1099s. Remember, we're using the form year based on the calendar year ending within the organization's fiscal year. Another note I would like to point out for fiscal year-end filers is that you will also have to report the fiscal year compensation for officers, directors, trustees, and key employees on Form 990 Part 9, Line 5. So you will have to provide the compensation for those employees on both a calendar year basis and a fiscal year basis. The next question we receive a lot is what should be included in other compensation from the organization? Typically, other compensation should consist of the following: tax-deferred contributions by the employer to a qualified defined contribution retirement plan, the annual increase or decrease in actuarial value of a qualified defined benefit plan, whether or not funded or vested, the value of health benefits provided by the employer or paid by the employee with pre-tax dollars that aren't included in reportable compensation. For this purpose, health benefits include payments of health benefit plan premiums, medical reimbursement and flexible spending programs, and the value of health coverage provided by an employer's self-insured or self-funded arrangement. Health benefits include dental, optical, drug, and medical equipment benefits, but they don't include disability or long-term care insurance premiums or allocated benefits for this purpose. We should also include tax-deferred contributions by the employer and employee to a funded non-qualified defined contribution plan. And finally, the annual increase or decrease in actuarial value of a non-qualified defined benefit plan, whether or not funded, vested, or subject to a substantial risk of forfeiture. So while I'm talking about compensation reported, I wanted to mention an update to the 2016 Part 7 instructions. There is a new instruction regarding professional employer organization, or PEOs. The organization may enter into an agreement with a professional employer organization to perform some or all of the federal employment tax withholding, reporting, and payment functions related to the workers performing services for the organization. The instructions have been updated to state that the organization should treat employees of a professional employer organization as the organization's own employees if such persons are common law employees of the filing organization under state law. Otherwise, the compensation paid to leasing companies and professional employee organizations should be treated like compensation to a management company for purposes of Form 990 compensation reporting. So while this update does provide some clarification on how to treat PEOs, it does leave some interpretation up to the filer regarding the relationship of the person who is working under the PEO. The last point on this slide I want to mention is the reporting of independent contractors. The IRS requires the organization to list the 5 highest compensated independent contractors that receive more than $100,000 in compensation for services, whether professional or other services from the organization. This compensation should also be reported on the calendar year ending with or within the organization's tax year. The compensation reported should include fees and similar payments to independent contractors, but not reimbursement of expenses unless incidental to providing the services. And now I'm going to hand it back over to George to discuss the revenue and expense reporting on the Form 990.
Yeah, thank you, Jana. So I'm covering now the Statement of Activities Reporting Form 990, Parts 8 and 9. This is Part 8 is a section where you report your revenue. Part 9 is the section where you report your expenses. So obviously both parts are very important parts of your 990, and they generally flow from your financial statements or your trial balance. However, there are a few points I want to mention that are peculiar to the 990 and that perhaps you should also take into consideration as you close your books. So the first point that's mentioned there is the issue of grants versus contracts. And again, Part 8, and this refers to Part 8, again, where you report your revenue from contributions, from program revenue, income from special events, your investment income, your realized gains, interest income, things like that. But there's a point that in the 990 is slightly different from the financial statements, and that is how it handles certain types of contracts. Generally, on the financial statement, grants that are considered contributions are recorded in a certain way, and then if you have contracts where you monthly present a bill or whatever to be reimbursed, you generally consider that earned revenue and report that perhaps as program revenue or contract revenue. The one wrinkle on the 990 that you should be aware of, and this affects particularly government contracts, is that if the direct beneficiary of the contract is the public rather than the government agency that's funding you, generally that amount would be reported in the contribution section of Part 8. The amount is the same. You don't adjust the amount that you report on the 990, but you would report such grants that benefit the beneficiaries rather than the organization itself in the contribution section. The second point that I want to talk about is donated services. Again, for GAAP purposes, many times we record donated services if, in fact, those services are specialized services which are typically paid for. If you receive such pro bono services on your financial statement, you generally would report that, both as income and expense. On the 990, however, those amounts are excluded both from revenue and expense. And so you would not report such services in either section of these forms. And it's now, on the other hand, donated goods, donated materials, things like that are in fact reported on the 990 and are not excluded. So you have to make sure that in keeping track of those things, you have kept track of that distinction. The third item I want to talk about, and this relates to Part 9, where you report your expenses, is the functional allocation ratios. And by that, and I'm pretty sure all of you would be aware of this, is particularly for 501c3s, we need to break out our expenses into three categories: program expenses, management and general expenses, and fundraising expenses. And on the Form 990 on Part 9, you do that not just in total, but by each natural category: salaries, occupancy, consultants, et cetera, et cetera. Now, most of you do this exercise also on your when you're doing your financial statements and your statement of functional expenses. You will have a sort of similar breakout, and that schedule is generally also shown by expense categories. The thing to be aware about for the 990 is that on Part 9, the expenses are broken out into a fair amount of detail, usually greater than you see on your financial statement. So, for example, the compensation of officers has its own line. Benefits are broken out into pension and other benefits and payroll taxes. Consultants have 4 or 5 categories. They have legal, accounting, lobbying, professional fundraisers. So the point to remember is when you are doing your functional allocation, when you're closing out your books or at year end, to remember, if you are doing this functional allocation for your financial statements, to sort of drill down a little bit and make sure that when you do the functional allocation between the categories, it will also be consistent when being shown on the 990. And so that might require you to drill down a little bit more in how certain expenses are being allocated. And that's very important because that is a ratio and a page that many outsiders and philanthropy watchdogs look at. And you also want it to be consistent with your audited financial statements, which have usually been issued already by the time you do your 990. So it's important that you think about that and how that will be reported on the 990 a little earlier as you're closing out your books. Okay. And so I will just cover briefly polling question number 2. What area of the Form 990 do you struggle with the most? Compensation reporting, identifying interested persons, related parties, public support test, or special event reporting? And we'll give you a couple of minutes to report that. And then I think the next slide, Jana will be covering.
Thanks, George. I'm going to talk about Schedule A, the public support test. So Schedule A of the Form 990 deals with the organization's public support test. So this test applies only to 501c3 organizations, and it provides reason for the organization's public charity status. I'm not going to get into the mechanics of the public support test today, but just give a quick overview of the 2 types of tests. So there are 2 public support tests for public charities. One for organizations that are described in Sections 509A1 of the Internal Revenue Code, and one for organizations described in Section 509A2. Both tests measure public support over a 5-year period. Generally, the 509A1 test requires that the organization receive at least 1/3 of its support from contributions from the general public or meet the 10% facts and circumstances test. And generally, the 509A2 test requires that the organization receive more than 1/3 of its support from contributions from the general public and or from gross receipts from activities related to its tax-exempt purpose. Under the 509A2 test, an organization can receive no more than 1/3 of its support from gross investment income and unrelated business taxable income. So let's talk a little bit more about the differences of a 509A1 versus an A2. Organizations that are public charities under Section 509A1 are contribution-based organizations. These organizations normally receive a substantial part of its support from a governmental unit or from direct or indirect contributions from the general public. Organizations that are public charities under Section 509A2 are more of a fee-based organization. These organizations typically receive funding generated from its program service activities. Where we commonly see a pitfall here are organizations that have started off long ago thinking they may operate as a fee-based organization, but have somehow over the years evolved into more of a contribution-based organization. However, they're still completing the test as a 509A2 organization. And there are some benefits of being a 509A1 over a 509A2, and I'm just going to quickly go through those. So the benefit of a 509A1 organizations are substantial donors are only those donors who have contributed over 2% of the organization's total support. There's an exception for donors from governments and other 509A1 of the 2% cap. If public support is less than 33 1/3, but at least 10%, the organization may still qualify as a public charity under the facts and circumstances test, which is a nice little safety net for organizations. And the facts and circumstance test is subjective and measures both financial and non-financial factors. And finally, there's no restriction on investment income, which benefits those organizations with a very large endowment fund. Now, before I hand it over to George to talk about unrelated business income, I would like to provide the second code word. The second code word for today's presentation is pineapple. Again, the second code word is pineapple. And with that, I'm going to hand it back to George to discuss Schedule C.
Thank you, Jana. Yes, I'm going to talk now about Schedule C, lobbying and political activities. This, you may have heard about these things. It's, these activities can be controversial. So it's a schedule that's sort of risen in importance, I would say. But in preparing the Schedule C, the first thing you should realize is that there's a distinction in the 990 world between what is lobbying and what are political activities. So the first thing you have to realize, okay, those are two different things, and we should know what they are. Political expenditures are all activities that support or oppose candidates for elective, federal, state, or local public office. So it's a fairly sharp definition. If you have political expenditures, if you have had activities that support or oppose candidates for an elective office. Lobbying, on the other hand, are activities that are intended to influence national, state, local, or foreign legislation. And there are two types of lobbying. There's direct lobbying, where there is an attempt to influence legislators, and then there's grassroots lobbying, which is the attempt to influence legislation by influencing the general public. So the first, again, so it's important to keep those distinctions in mind as you move forward. The second thing about the Schedule C is that it affects different type of exempt organizations differently. Again, I'm assuming most of you that are attending the seminar now, this webinar, are either 501c3, 501c4, or 501c6s. And the rules about what you're most directly affected by on the schedule differ depending upon your classification. So very briefly, without going into all the subtleties or different ramifications of that, for 501c3s, it's fairly straightforward. They cannot do any political activity, okay? They shouldn't be doing any political activity. 501c3s are permitted to do lobbying within certain limits. And so I will talk a little bit about that later on, but 501c3s can do both direct and grassroots lobbying, but there are limits to the amount they can do, generally limits that depend upon the total size of their expenditures. 501c4s and 501c6s can engage in political activities. C4, there are limits, generally should not exceed 50% of their total expenditures. The other thing you should be aware of for C4s and C6 is that there may be a tax that is incurred because of your political activities. And then for 501c6s, they should also keep track of the lobbying they do. Generally, lobbying paid by when for-profit organizations pay lobbyists to do lobbying for them, that is not a deductible expense for them on their corporate return. So as a C6, if you do lobbying on behalf of your members, generally you have two options. You can pay a tax for the lobbying you do, and then all of your members can deduct the lobbying amount in full. On the other hand, you can then inform the members of what percentage of your membership dues that you have used in carrying out lobbying activities. They have that information so that they can then adjust the amount of deduction that they take on their returns for the dues that they paid you. The last item I mentioned is a 501H election. Again, this is applicable only to 501c3 organizations. And what this does is it provides not-for-profit organizations with an election that gives them firm and fixed numerical limits that they should not exceed when they are doing either direct or grassroots lobbying. Now, if they do exceed it 1 year, they have to pay a tax on the excess. But in general, it gives the organization a guide saying, okay, given the size of our expenses, we shouldn't be doing any more grassroots or direct lobbying than this X amount. Now, this is not a required election. It's something that's elective. If you don't make it, then lobbying should not be, should not constitute more than an insubstantial amount of your activities for the year. That's not, well defined. Which is why some organizations, like to make that 501H election and have a certainty. Now, the last thing, that election, you can make it. You can then also unelect subsequently if you decide you don't like it. So that is an option that 501c3 organizations should consider if they're going to be doing lobbying.
Hi everyone, this is Caitlin again. The next schedule I'm going to touch on is Schedule G, and I'm going to focus specifically on Schedule G Part 2, which is where you report fundraising events. This schedule is required to be completed if the organization had more than $15,000 of gross receipts from fundraising events. Fundraising events will most typically include your dinners, dances, concerts, auctions, and your galas. It does not include activities substantially related to the accomplishment of your mission, other than raising funds. So for example, a trade show or an annual meeting wouldn't typically qualify as a fundraising event. So the first thing you'll have to determine is if the event in question actually qualifies as a special fundraising event. If you do have a fundraising event, you'll have to report the revenue and expenses related to that event on Schedule G Part 2. The most common question that we get asked about this schedule is the breakout of gross receipts between lines 2 for contributions and lines 3 for gross income. If the ticket to your event is more than $75, then you need to be notifying the donors the value of their ticket price that is consideration for goods and services received at the event. So this will most typically include the food, the drinks, entertainment, what have you that they're receiving at the event. You're basically trying to calculate what the attendee would pay for the evening if they were getting a similar meal or experience at a restaurant or another venue. Sometimes clients think that they can calculate the value by taking their cost for the food or the venue, but value doesn't necessarily equate to the cost. Often the food or the drinks will be donated to the charity for the event, but that doesn't mean that the attendee is getting zero value out of their food and drinks. So you really need to do an analysis to determine the value piece that you'll be notifying attendees. In completing Schedule G, you'll take that value piece that we just talked about, the value of the ticket price, which is going to be the non-deductible part, and you carve that out of your gross receipts. This will leave the charitable contribution piece, or the tax-deductible piece, to report on line 2. Once you have lines 1, 2, and 3 completed, the remainder of the information will be identifying the direct expenses related to the event. The only thing I'll mention about expenses is related to labor costs and wages. Because the expenses should just be the direct expenses, for labor costs and wages, you should include the amount of compensation paid to event workers or paid to independent contractors for labor costs. So you should not be including an allocation of staff time for attending the event unless that staff is actually working the event. Otherwise, expenses should be pretty straightforward. Just make sure to keep records of the direct expenses of the event to support reporting on this schedule. The next schedule that I'm going to talk about is Schedule L, which is transactions with interested persons. So the first thing that we need to determine is who is an interested person. The instructions identify many types of interested persons, so I wanted to review those different classifications together today. Interested persons include 1. A person required to be listed on Form 990, Part 7, Section A as a current or former officer, director, trustee, or key employee. So Jana touched on this a little bit earlier, but anyone in your Part 7 is going to be considered an interested person. It's also important to mention that the determination of former uses a 5-year look-back period. So if the individual was listed on any of the past 5 990s, then they could qualify as a former officer, director, trustee, or key employee. Now, the second type of interested person is defined as the creator or the founder of the organization, including the sponsoring organization of Aviva. The third type is a substantial contributor. For purposes of Schedule L, a substantial contributor is an individual or organization required to be reported on your Schedule B. So depending on your type of charity classification that we talked about earlier, that could be all donors $5,000 and above, or donors giving over the 2% of your total contributions for the year. This type of interested person was new in the 2014 instructions and raised a lot of questions. So the 2016 instructions actually provided some clarity on reporting substantial contributors as interested persons, and I'll touch on that in a little bit more detail in a minute. The fourth type of interested person is for Part 3 of Schedule L only, which is grants to interested persons, a member of the organization's grant selection committee. The fifth type is a family member of anybody that I just mentioned. And then the sixth type is going to be a 35% controlled entity of any of the people that I described above. And then the last type of interested person is again only going to be for Part 3, and it will be an employee or a child of an employee of a substantial contributor or of a 35% controlled entity of such person, but only if that assistance was awarded by the discretion or advice of that person or under a program funded by that person. So as you can see, it's quite an exercise to go through all of your employees and your board members and your related entities to determine if any of these relationships exist for reporting on Schedule L. We've found that a questionnaire is often helpful in determining these relationships, and that can be distributed among your members of the organization to help identify if any of the above relationships exist for reporting on Schedule L. I wanted to jump back to the substantial contributor type of interested person, and we've mostly seen this apply for Schedule L Part 4, which is where you would report business transactions involving interested persons. So what this is trying to look for is a business transaction outside of the grant or the contribution with those substantial contributors. So for example, if you're a school and a parent pays for their child's tuition fees, but they also give a gift to the school, then assuming that they meet the reporting thresholds for both Schedules B and Schedule L, then they may need to be reported here. Another example that we've seen often is an organization who hosts a trade show and has registration fees for the event. If any of those registrants also give a gift or a donation to the organization, then again, assuming both transactions meet the reporting thresholds for B and L, they may need to be reported on Schedule L Part 4. Before the 2016 instructions provided clarification, there was concern about identifying substantial contributors by name on Schedule L, which is not redacted as part of the public disclosure version because the donor names and addresses were not open to public inspection. So with the updated guidance in the 2016 instructions, we're now instructed to put the term substantial contributor or related to substantial contributor in the name field instead of identifying the donor's name. And then in the relationship field, you can also just put that term substantial contributor or related to substantial contributor. So this updated guidance was very helpful for us in answering our concerns of listing donor names on Schedule L. The next schedule that Jan is going to touch on is Schedule R for related organizations.
Thanks, Caitlin. And as she mentioned, I'm going to discuss Schedule R, related organizations. Schedule R is used by an organization that files the Form 990 to provide information on related organizations and certain transactions with those related organizations. A related organization is one that stands in one or more of these relationships at any time during the tax year to the filing organization, a parent, a subsidiary, brother, sister, and supporting supported organization. A disregarded entity is also treated as a related organization for purposes of reporting on Schedule R. However, they don't need to be disclosed on Part 5, which represents transactions with related entities. Relationships can involve both not-for-profit and for-profit organizations. And for determining who our related entities are, we want to look at the definition of control. So control of a nonprofit organization occurs when one or more persons, whether individuals or organizations, have the power to remove and replace or to appoint or elect a majority of the nonprofit organization's directors or trustees. Also, an organization controls a nonprofit organization if a majority of the subsidiaries' directors or trustees are trustees, directors, officers, employees, or agents of the parent. Control of a stock corporation exists if one or more persons, whether individuals or organizations, own more than 50% of the stock of the corporation. Control of a partnership or limited liability company exists if one or more persons own more than 50% of the profits or capital interest in the partnership. So organizations should review these definitions to confirm what, if any, organization should be reported as related. If an organization has a related controlled organization, they may need to disclose transactions between the filing organization and the related organization. There is a $50,000 threshold for reporting the transactions with a controlled entity. However, if the transaction includes payments of interest, rents, or royalty with a controlled entity, this threshold does not apply and they must be reported regardless of the amount. In addition, 501c3 organizations need to disclose transactions with related non-501c organizations, regardless if there's control. So if a 501c3 organization has a related 501c4 or C6, the organization may need to report these transactions regardless if there's a control of those organizations. And before I hand it back to George to discuss unrelated business income, I'd like to provide you with the third and final code word for today. The final code word is Kiwi. Again, the final code word is Kiwi. And with that, I'll hand it off to George.
Thank you, Jana. So I'm going to talk briefly about unrelated business income, Form 990T. So as a not-for-profit organization, obviously, generally, most of our revenue, et cetera, is not subject to income tax because it's being used and generated through an exempt activity, through a charitable activity. However, an organization can, if you will, on the side, perhaps conduct an activity which is not directly tied to its exempt purpose, and therefore may be subject to income tax. And that is what the Form 990T is used to report if, in fact, there are such types of activities. So for something to be considered unrelated business income, there are three characteristics that must be part of that activity. One, it has to be regularly carried on. Now, that is a little bit of a term of art. You can't just sort of think about the regular, what the definition of what you think regularly carried on is. For example, if an activity is done only once a year, even if it is done, every year for once a year, generally that would not be considered regularly carried on, though in some sense, in a sort of a common sense way, you might say, oh, that's a regularly carried on activity. So generally, the activity is performed throughout the year or at intervals of perhaps quarterly or monthly. At that point, it would probably be considered regularly carried on for purposes of the 990T. The second item is unrelated to the organization's exempt purpose, and this is very important and is something that can lead a little bit to some confusion. Often looking at a particular activity that an organization is doing, if I ask the client, do you think this may be subject to UBIT, or how is this related to the organization's exempt purpose, the answer I'll get is, oh, yes, it's related because we use all the money that the activity generates to carry on, the various things that the organization does. And while it's great that those monies are being used for that, that's not what exempts, if you will, or that not what disqualifies an activity from being UBIT. The activity itself, not what you do with the funds that the activity generates, is what is looked at to see whether the activity itself is directly related to your exempt purpose or contributes importantly to the exempt purposes of the organization. If it does not, then it would probably be considered unrelated to the organization's exempt purpose. And then the third one, the income from a trade or business. Normally, the activity should be conducted for the production of income with the intent to profit. And so what that definition is trying to exclude, if there's an activity that you always conduct at a loss and that you are doing in such a manner that you would never have income, then that would be knocked out of unrelated business income, because it is not, that's, normally when you're into doing business or trying to be, doing an activity that's a business activity, the point of that is to generate a profit. So those are the three items that certain activities that you have should be analyzed to see if they fit into this model, and then if they do, you need to consider whether 990T should be being filed. Now, what's the threshold for filing the Form 990T? The threshold is $1,000. If you have $1,000 of gross income from the activity, then the activity, you would need to file the Form 990T, whether or not you actually end up having net income. You report, obviously, revenue and expense for the activity here, and if you have you may have a gain or a loss, but you need to fill it out if the gross revenues exceed $1,000. Typical UBIT activities are things like advertising in a publication, because advertising is not considered usually an exempt purpose activity. Possibly ads on your website could trigger UBIT, and things like debt financed rental income, items like that. Finally, I'll say as a sort of housekeeping, if you are subject to tax, you generally need to pay that quarterly. The tax is regular corporate rates, and for people that organizations located in states that have a state income tax, they typically would want their share too. You may very well have to file a state corporate income tax to report your 990T income if you fall into that category. And after that, now I'm going to pass it on again to Jana, who will give us certain updates.
Thanks, George. So there has been an update to Form 8868, which is the form used to request an extension of the Form 990. Starting with tax years that begin after December 31st, 2015, upon timely submission of an extension request, the IRS will automatically grant a 6-month extension for 990 filings. So what that means is that for organizations with a calendar year end on December 31st, 2016, that seeks an extension by the initial due date of May 15th, their filing deadline will effectively change to November 15th, where in the past you had an automatic 3-month extension. So for calendar year-end client organizations with December 31st, 2016, previously you would have to apply for an extension at May 15th and then ask for a second extension August 15th. In addition, there has been a change to the filing deadline of reports of foreign bank and financial accounts, the FinCEN Form 114, to report foreign financial accounts. This due date has changed from June 30th to April 15th. And this update was made to change the due date to April 15th to coincide with the federal income tax filing season. In addition to the change of the initial due date, there is a maximum 6-month extension of the filing deadline. So specific requests for this extension are not required. A filer of the FinCEN Form 114 will receive an automatic extension to October 15th each year. And that brings us to the last polling question. So polling question number 3. For a 12/31/16 nonprofit, what is the new due date after filing the first extension? A, May 15th, 2017, B, August 15th, 2017, or C, November 15th, 2017. So at this point, we'd like to open it up for questions So while we gather your questions, I'm just going to review the key takeaways from our presentation today about avoiding compliance pitfalls. The first thing we want you to take away is to stay current. So you should be aware of any updates and changes to the Form 990 throughout the year. You want to be proactive. You want to make sure you're gathering your information on a timely basis from third parties or internally. And you want to evaluate often. So you want to evaluate any new activities or changes of the organization that may have an impact on your Form 990 reporting. And at this time, we'll check and see if we have any questions.
I see a few questions coming through. The first one that I'll address is it sufficient to provide a public disclosure copy of the Form 990 to our board for review? I can address this one since I touched on it in one of my slides earlier. You may choose to provide the public disclosure copy of the Form 990 to your board for review, but in order to answer that question, yes, which is Part 6, line 11, you must provide a complete copy of the return. So that would include Schedule B. So if you want to answer yes to that question, then the public disclosure copy would not suffice. And I'll just mention also along the same lines, a lot of people ask if they can provide the 990 to the Finance Committee for a yes answer to that question. And that will also not qualify for yes. It's not a required practice, but if you want to answer yes to that question, then a complete copy should go to the full board, not just a committee of the board. So I hope that helps. Looking through, I see a question about Part 7. So Jana, do you want to take this? It's, what if our executive director doesn't make $100,000? Does that mean I don't need to list him on Part 7?
Okay, so typically an executive director of an organization is classified as an officer, meeting the definition as a top financial official, and officers don't have a reporting threshold. So regardless of what the compensation of an officer is, it should be reported on Part 7 of the Form 990.
Okay, great. Another question says, you mentioned that some organizations may have to pay a tax if they have too many lobbying expenditures. Can you elaborate on that? And George, do you want to take that one since you had the Schedule C slide?
Okay, Caitlin, yes, I'll talk about that. Yes, I did mention that there can be a tax related to political expenditures, and normally that is reported on a separate form, 1120 POL, which usually asks you to pay a tax on the higher of your investment income or your exempt expenditures, and by exempt expenditures they generally mean political expenditures, and then that whichever one is higher, you pay a tax on that, and that is paid at the highest corporate tax rate, which is 35%. What that means is you kind of have to plan for that. Some individuals believe, or some organizations will believe, that it is worth it to pay the tax because the political expenditures you make are benefit to what you're trying to do. But it's again important to know that that is something that you should take into account. You may be subject to that, and there can generally be also a state tax involved with that. So that's what I'm talking about. I just noticed there is one other question that has come up that's in this area, which asked me to say, would you clarify again the difference between lobbying and advocacy? And that's a good question. Many times there's a distinction, or people say, look, yes, I advocate for things, or we are involved in sort of education, educating the public about certain items. Is that lobbying? And while that's a somewhat complex area and a subjective area, it's important to sort of remember that lobbying has a specific definition of, yes, what we are trying to do is to influence legislation, either by contacting legislators directly, a piece of local, federal, or foreign legislation, or we are trying to influence the public on a specific piece of legislation. We are trying to influence the public so that they will influence a legislative body regarding a specific piece of legislation. So in some ways it can be broad, in some ways it can be narrow, and your advocacy activities may be broader than that, and maybe, you know, general education of the issue without specifically addressing a specific piece of legislation. So that's an important thing to keep in mind when, again, you navigate these rules and these activities. And the best thing to do is to make an analysis of those activities at some point to see if they would fall under the rubric of lobbying or not.
Someone asked if I could repeat the first criteria of independence. So that was, again, when you're looking through your voting board members to see who's independent or not independent. And that first criteria was that the member was not compensated as an officer or other employee or a staff member of the organization or of a related organization. So, for example, if your CEO is a voting board member and that person also receives a salary, then they would not be independent for purposes of that question. I think we're nearing our time mark for the 1 hour. So I think we'll wrap it up for today. But if you have any other questions or if you think of something after the presentation, please feel free to reach out to us. Our contact information is on this last slide. And then finally, please join us for our next webinar, which will be Effective IT Controls for Financial Statement Audits. Is your organization at risk? This will be held on March 29th, and we'll be sending out more information for registration soon. Thanks again, everyone. Have a great day.